Your retirement account may be about to buy a rocket company, and nobody asked you. That is not a glitch. It is exactly how index funds are designed to work. The mechanism behind it is what we call the invisible rebalance. The invisible rebalance fires every time a giant company enters an index you already own. An index is a ranked list of companies governed by a published rulebook. Nothing more mysterious than that. The S&P 500 tracks roughly 500 large U.S. companies, ranked by market capitalization. Market cap is share price multiplied by total shares outstanding, simple arithmetic with big consequences. The bigger your market cap, the bigger your slice of the index pie. An IPO is the day a private company first sells shares to the public, the opening of the door. Before the IPO, SpaceX carries zero weight in any public index. It simply does not exist there. Once it lists and meets eligibility rules, the index committee evaluates it for inclusion. If approved, it can leap from zero to a top 10 holding almost overnight. That overnight leap is the invisible rebalance firing at full power. SpaceX's last reported private valuation was around $350 billion in early 2025. At that size, it would rank among the 10 largest companies in the S&P 500 on day one. A $350 billion company represents roughly 1% of the whole index. Give or take. 1% sounds small, but the entire energy sector is only about 3 to 4% of the S&P 500. So the invisible rebalance could add a quarter of an energy sector's worth of exposure in a single day. The S&P 500 Index Committee meets and votes on additions using published, transparent criteria. A company must be U.S. domiciled, show positive earnings over 4 consecutive quarters, and pass liquidity tests. Once approved, the committee announces the addition date, typically giving funds around 5 business days. Every fund tracking the S&P 500 must buy the new stock before that deadline, or it will track the index poorly. That forced buying is entirely predictable, and predictability has a price for existing fund holders. When hundreds of funds must buy the same stock inside 5 days, demand spikes and the price rises. Research suggests stocks added to the S&P 500 tend to rise several percent around the announcement window. Funds that must buy at those elevated prices pay more than the stock was worth the week before. This is the first layer of the invisible rebalance cost, absorbed silently through slightly lower returns. For a mega-IPO the size of SpaceX, even a modest entry premium on a $350 billion stock is enormous in dollar terms. Active traders who bought SpaceX before the announcement can sell to the funds at inflated prices. Passive index fund investors are the ones buying at those elevated prices through their funds. This wealth transfer from passive to active is the invisible rebalance at its most expensive. When SpaceX enters the index, every existing company's weight shrinks automatically to make room. A holding at 2% of the index might slip to 1.97% after a mega-IPO addition. Multiply that across 499 existing companies, and the dilution is real, automatic, and universal. Your fund quietly sold fractional shares of every existing holding to fund the SpaceX purchase. This is the second layer of the invisible rebalance, silent portfolio reshaping without your vote. The S&P 500 is already historically concentrated. In recent years, the top 10 holdings have exceeded 30% of the index. Adding another megacap pushes that concentration even higher after the invisible rebalance fires. Concentration means your diversification benefit shrinks, eggs crowding into fewer baskets. A useful measure, a portfolio of 10 equal holdings has an effective N of 10. Concentration cuts that number. Lower effective N means one bad company can hurt your whole fund more than it used to. SpaceX is a high-growth, high-volatility business. Rockets explode. Contracts are won or lost overnight. High volatility means large daily price swings, adding variance to your whole fund's returns. Variance is the enemy of compounding. A 50% loss requires a 100% gain just to break even. Even a 1% weight in a volatile stock can measurably nudge your fund's standard deviation upward. This is the third layer of the invisible rebalance, hidden volatility imported into your portfolio. Factor investing holds that returns are driven by characteristics like value, size, momentum, and profitability. SpaceX at IPO would likely carry strong growth and momentum factor loadings. Adding it shifts your index fund's factor profile toward growth and away from value. Over long horizons, academic research has generally found value stocks outperform growth, though results vary by period. The invisible rebalance quietly tilts your factor bets without you ever touching a single setting. Diversification works best when holdings move independently. Low correlation is the whole point. Megacaps tend to be more correlated with each other because they all react to the same macro forces. When SpaceX joins other megacaps in your fund, average pairwise correlation in the index nudges upward. Higher correlation means your fund behaves more like a single concentrated bet than a diversified basket. This is the fourth layer of the invisible rebalance. Your diversification quietly shrinks. Stocks entering an index near their IPO often arrive at peak excitement and peak valuation. Price-to-earnings ratios at IPO for high-growth names are often double or triple the broad market average. Paying a high P/E means handing over more money today for each dollar of future earnings. Research broadly shows high valuation stocks added to indices tend to underperform in the following year. The invisible rebalance forces your fund to buy at exactly the wrong point in that valuation cycle. Past mega-IPOs teach us something. Uber, Lyft, and Airbnb all entered indices after massive public listings. Uber joined the S&P 500 in December 2023 at a market cap of roughly $140 billion. Uber's stock performed strongly after inclusion, but that outcome was far from typical. Many other IPO additions have underperformed the broader index in their first year after inclusion. Studies of index addition broadly find new entrants lag the index modestly in the months after joining. On a position the size of a SpaceX entry, even a modest lag translates to billions of dollars of potential drag. Here is what this means in concrete terms. Say you have $100,000 in an S&P 500 index fund. At roughly 1% weight, about $1,000 of your money moves automatically into SpaceX. If SpaceX lags the index by 2% in year one, that costs you around $20. $20 is roughly 2 bags of groceries, gone quietly through the invisible rebalance. And that is just one mega-IPO. The index adds dozens of new companies every year. The invisible rebalance is not purely a cost. It also delivers automatic exposure to companies that win big. If SpaceX becomes the next Apple, growing tenfold, your fund captures every % of that gain. Missing a 10-bagger because you were outside the index is a real opportunity cost for stock pickers. This is the core trade-off. The invisible rebalance costs you at entry but rewards you if the stock wins. The question is whether the forced entry price tilts that scale against you on average. Early academic work documented a price increase around S&P 500 additions, the so-called index effect. Later research found the initial price pop partially reverses over the following months. The net effect is a small but persistent entry cost that quietly erodes index fund returns over time. Estimates of this drag vary, but even a fraction of a % per year compounded is meaningful. Compounded over 30 years, small annual drags can meaningfully reduce your final portfolio value. A cap-weighted fund gives giants more weight, amplifying the invisible rebalance effect. An equal-weight fund gives every company the same slice, reducing but not eliminating the effect. Equal-weight funds have historically added return over cap weight, but come with higher turnover and costs. Every time the index rebalances to add SpaceX, funds must sell existing holdings to raise cash. Those sales can trigger capital gains distributions that land unexpectedly in your taxable account. Inside a tax-advantaged account like a 401,000 or IRA, this turnover tax effectively disappears. In a taxable brokerage account, Even a passive fund can generate surprise tax events at rebalance. Sophisticated traders know the announcement date and buy SpaceX before the index funds are forced to. They then sell to the index funds at a higher price, pocketing the spread, a practice called index front-running. This is legal and well documented. It is simply the cost of being a price taker in a transparent market. The invisible rebalance makes every passive investor a price taker at the least convenient moment. For a SpaceX-sized entry, that moment could shift substantial value from passive funds to active traders. If SpaceX lists at $350 billion and grows toward the $1 trillion range, its index weight could triple. At $1 trillion, it would rival the largest companies currently in the S&P 500. That would give it roughly 3% of the entire index, comparable to some whole sectors. Every dollar added to your S&P 500 fund would automatically route 3 cents to SpaceX. SpaceX would likely land in the industrials or communication services sector. The committee decides. Whichever sector it joins instantly becomes more concentrated and more volatile. Hold a sector ETF in that category, and your concentration problem doubles through the invisible rebalance. Investors holding both an S&P 500 fund and a matching sector fund often unknowingly stack their bets. At $350 billion, SpaceX is far too large for the Russell 2000 small cap index. It goes straight to large cap. Total market funds like VTI capture virtually the entire US market by design. Hold a total market fund and SpaceX enters automatically through the same invisible rebalance mechanism. The effect is smaller in total market funds because the denominator is larger, thousands of companies. SpaceX is a US company, so it will not appear in international or emerging market index funds. Investors with meaningful international allocations are partially insulated from this invisible rebalance. Geographic diversification across regions is one structural way to reduce single company concentration risk. A globally diversified portfolio naturally carries less SpaceX exposure than an all-US fund. Bond index funds are completely unaffected by equity IPOs. SpaceX cannot enter a bond index. A stock-bond blended portfolio automatically limits your IPO-related equity exposure to the stock portion. However, high-volatility stocks like SpaceX can affect broader equity market correlations. Even bond holders feel ripples. In a broad risk-off event, high-volatility stocks can drag the whole equity market lower. At IPO, SpaceX shares may have limited float. Not all shares are available for public trading immediately. Low float means even moderate buying pressure can move the price dramatically. Index funds buying a low-float stock amplify their own price impact. They push the market against themselves. This is the fifth layer of the invisible rebalance. Liquidity risk baked in at the moment of inclusion. As float grows after lockup expiry, this risk fades, but that process takes months. Insiders and early investors face a lockup period, typically 90 to 180 days after IPO, before they can sell. When the lockup expires, a flood of insider shares can hit the market and push prices down sharply. Your index fund holds through that cliff because it must. It cannot exit before the index removes the stock. Active managers can reduce exposure before lockup expiry, an option the invisible rebalance denies passive investors. Everything discussed assumes SpaceX actually meets S&P 500 eligibility criteria, which is not guaranteed. SpaceX must demonstrate 4 consecutive quarters of positive GAAP earnings, a high bar for a capital-intensive rocket company. The committee could delay, reject, or route it to a different index. All outcomes remain possible. Market conditions at IPO time will determine the actual entry price and weight, unknowable today. Every number used here is illustrative. Actual impact depends on IPO price, float, and index rules in effect. Start by understanding your current exposure. Check what percentage your fund holds in its top 10 names. Most fund providers publish daily holdings. A 5-minute check gives you a clear concentration picture. If concentration concerns you, Equal weight or factor-tilted funds can reduce mega-cap dominance. Geographic diversification through international index funds spreads the invisible rebalance risk across more markets. Tax loss harvesting in taxable accounts can offset some of the turnover tax triggered by rebalancing. None of these are specific trade recommendations. They are structural choices to understand and discuss with a qualified advisor. Here is the deep irony. The more popular index funds become, the more pronounced the invisible rebalance effect gets. As passive ownership grows, forced buying at inclusion moves prices more than it did in earlier decades. Passive investing remains the right structural choice for most people, but it is not frictionless or risk-free. Understanding the frictions lets you make smarter decisions without abandoning the passive approach. Let's stack all 5 layers of the invisible rebalance for a mega-IPO like SpaceX. Layer 1. Entry price premium. Funds must buy after the price has already risen on the announcement. Layer 2. Silent dilution of every existing holding to make room for the new entrant. Layer 3. Imported volatility raising your fund's standard deviation and quietly harming compounding. Layer 4. Correlation creep reducing effective diversification across the whole fund. Layer 5. Liquidity risk at entry when float is low and price impact is highest. Together, these layers are the invisible rebalance, small individually, but meaningful when compounded over decades. If this helped you see your index fund differently, subscribe for more data-driven investing explainers and drop a comment. Did the invisible rebalance surprise you? This video is for general educational purposes only and does not constitute financial, tax, or investment advice. All numbers are illustrative. Consult a qualified financial advisor before making any investment decisions.